Crude oil and gold. They're on the minds of every investor and trader right now, and it's easy to understand why. The latest crisis in the Middle East has energy market participants asking, what's next? What will Israel-Iran conflict mean for prices? And what should I do in response? Meanwhile, gold is gaining on safe haven buying in the short term, but it has been running for much longer, far outpacing equities in the process. To get to the bottom of these critical developments and give you expert insights into what to do, we have a special double episode of the Money Show Money Masters podcast for you. My first guest is Anas Al-Haji, Managing Partner at Energy Outlook Advisors. He's one of the nation's foremost experts on crude oil, natural gas, and product markets, and you'll find his behind-the-headlines analysis of the current conflict enlightening and actionable. Anas, thank you so much for joining me. Obviously, this is a market where energy is clearly in focus given what's going on in the Middle East. So I want to start from there and just try and get sort of a 30,000-foot view up here. We're recording on Tuesday. We don't know exactly what will happen before this airs on Thursday. But what are your thoughts on what's happening now and the potential impact on crude oil for starters?
Well, the questions we get, we've been getting like hundreds of them in the last few days is, will Iran close the Hormuz Strait? Will they cause problems in the Hormuz Strait? What is the impact if we lose Iranian oil or some oil in the Gulf, etc.? These are the main questions, and I'll be happy to answer them quickly since our time is limited. Of course, the media is doing a very bad job exaggerating things or sometimes are just lying. And then social media takes that and amplify it a zillion times.
Yeah.
I'm going to give you a couple of examples on the exaggeration. The first one is we have headlines that Israel hit the largest gas field in the world. And people panicked. Well, the largest gas field basically is shared between Iran and Qatar is not part of the war. And most of it is in Qatar, not in Iran. And the one in Iran basically is being developed over decades in 24 phases. And they are in phase 14 right now. And phase 14 has several projects, including a small refinery, just kind of like to separate the liquids from the gas. And that refinery has 4 units. And the drone hit one of those units.
Mm-hmm.
So you are talking about 1 of 4 out of 14, out of 24, out of the smaller portion of the gas field, yet the headline, Israel hits the largest gas field in the world.
Yeah.
So people panicked as a result of that. Then we have another statement that went viral on social media. We have a member of the Security Committee in the Iranian parliament, which is called Majlis, saying that we are studying the probability of closing the Hormuz Strait. The first fact about this is that this is just like the Congress, the US Congress, but with like 1/10 of the power. This committee has no power at all. The Majlis itself, the whole parliament, has no power at all, has no say in foreign policy, has no say in security policy, has no say in anything strategic, period. But people took it seriously, while this man has no authority, has nothing at all. The fact is, there is no way Iran can block the Hormuz Strait. And here we have to distinguish between blocking the strait and causing disturbances in the Gulf and the Strait. And we have to pay attention to those expressions because a lot of people are fighting and they find out they are talking about 2 different things.
Got it.
So now I'm talking about closing the strait, not causing disturbances. Iran cannot close the strait. It's very wide. And the strait is between Iran and Oman. And the part in Iran is shallow waters. The part in Oman is deep waters, which means that the ships entering and exiting the Gulf are in the Omani waters, not in the Iranian waters. So if Iran wants to close the strait, they have literally to occupy Omani waters.
Okay.
Okay. So that's not the case. They don't have the power. Even if you look at all the studies being conducted by all the military schools and all the war schools and all the strategists for the last probably 70 years, they've been studying the Hormuz Strait. And if you look at all those military studies, you see that many of them said, yes, the Iranian Navy can occupy the strait for probably a few hours, and that's it.
Okay.
The strait is protected by the US Navy, by the British Navy, by the French Navy, by the Indian Navy, by the Pakistani Navy, by the Saudi Navy, by the Omani Navy, and then there is a group of 34 countries, a coalition of 34 countries, and they have a base in Bahrain. They are entrusted with protecting the navigation in the Gulf and the strait. So when it comes to blocking, they cannot block it. Now, is it in Iran's interest to block it? And the answer is no, for the following reasons. 80% of Iranian imports comes through the strait. In fact, most of the food that Iranians eat on daily basis come through the strait, which means that if they block it, they are going to choke themselves first before they choke anyone else. And all their seaborne exports, everything, goes through the strait. And we know that their economy is in dire situation and they are in dire need of money. So if they block themselves, they choke themselves too on the exports. So it is not in their interest. But this is really not the big story. The big story is if they do anything, now we are going to move on to the disturbances. If we talk about disturbances, if they go and do anything in the Gulf, who is going to suffer? It's their allies, it's their friends who are going to suffer the most. It's China and India who is going to suffer the most. Why? 83% of the oil that is leaving the Gulf goes to Asia. Very little oil from the Gulf comes to the United States. Very little oil from the Gulf goes to Europe. So that means they are going to hurt their friends first. So they hurt themselves, they choke themselves, and then they hurt their friends. They are not going to affect the US, they are not going to affect Europe, they are not going to affect Israel.
And this is a major difference. This is a major difference from the historical situation if you go back to the 70s, clearly, yes?
Absolutely, absolutely. Things changed, and I will explain why. But if you look at LNG, 87% of LNG from the Gulf goes to Asia. Very little goes to Europe, none goes to the United States, zero. So on one side, they hurt themselves, on the other, they hurt their friends, and they're not going to hurt their enemies. So why do it? Yes, those disturbances will cause higher oil prices, they will cause higher LNG prices, but as I'm going to explain in a few minutes, higher oil prices for how long? For a very short period of time. So they lose again. And the reason, to go back to your point, simply because right now, 60% of US oil imports come from Canada. About 86% of US imports come from the Americas, which means that it comes from Canada, Mexico, and South America. It's no longer the Middle East, it's no longer Africa and others. So whatever they do, the only way they can hurt the United States is by higher prices. But what they don't realize is we already learned a lesson from the Biden era. We have something called strategic petroleum reserves. We can just dump it on the market. And Trump can do it. I know Republicans criticized Biden, but you will see all of them. If oil prices go to 90, you will see Trump and the Republicans doing exactly what Biden did. Release oil from the SPR. But to go back to this point, yes.
No, I wanted. Since you brought it up, I just want to touch on the SPR. I mean, I have seen people say, "Oh, there's not as much oil as there used to be in there." Thoughts on if that really matters in this particular conflict? Is there enough?
That was an exaggeration, and political statements being made. Even at the lowest point, we had 350 million barrels in the SPR, which is more than enough for any crisis. People exaggerated that just because of the politics of it. Right now, we have over 400 million barrels in the SPR, so we have plenty of oil in the SPR. But the question is, seriously, if we lose some oil from Iran or from the Gulf countries, what is the impact on the market? There is something weird happened in the last 2-3 weeks.
Okay.
Just before the attack on Iran, Iran exported more oil than what they've done in a very, very long time. And China built its inventories to the highest level ever. Just in the last 3-4 weeks before the attack. So was this coincidence? Or they knew something? And if they knew something, how Iran was able to do that despite Trump's sanctions and the enforcement of Trump, and he's been doing this since he came to office? Did they empty their storage tanks so if Israel comes in, they have nothing to hit? But the idea here is very simple. Let's say that, China, of course, most of the Iranian exports go to China. China now, in storage, has massive amount of Iranian oil, which means that they have no problem with the quantity, and they have no problem with the quality, crude quality. They have both, because the same oil. And they did buy it at the cheaper prices, not the prices of today. So what refiners are going to do, they are going to go back to that storage and literally replace Iranian oil with Iranian oil they bought at the cheaper prices in the past. And we did several exercises and several scenarios, and we published a report in a couple of, immediately after the events on Friday. We published a report and we published one scenario out of those. The scenario basically is if China loses all its imports from Iran, they can literally replace it from oil from their inventories. And if they go for 3 months straight, no imports from Iran and no increase in imports from any other country, their inventories will decline by a small amount that will bring them back only to the levels of 2022 when they have the lockdowns, basically, and their inventories went up, which means that they will still have massive amount of inventories, even if they don't import any additional amounts from any other country. So the first line of defense is China's inventories. It can be in the market in matters of hours, and I think they are already doing it. The second line of defense to compensate is that we have the group of 8. They are going to meet very soon to determine the increase in August. And the expectation is that they are going to add 411,000 barrels a day. They can add more if they want to. The spare capacity that exists, they can add at least 1.5 to 2 million barrels a day, which is way more than the Iranian exports if they can. And people say, well, is the Gulf, everyone is going to be affected? Well, there are 2 pipelines from the east to the west in Saudi Arabia. Their capacity is 5.5 million barrels a day. They can just take it to the Red Sea. And it's not affected by the Houthis, by the way, because they have an agreement with the Houthis, and they can send those to Europe without even the Houthis being in the picture at all. So they can compensate for that. So that's the second line of defense. The third line of defense, if oil prices rise significantly, we are going to use the SPR, and we will see Trump using the SPR. They can release about 60 million barrels out of the SPR, which is the same amount we added since last year to the SPR. He'll bring it back to 350 if needed. And then as we go through time, we have another issue. Throughout the summer, those countries in the Middle East, their demand for oil domestically increases substantially because of the demand for cooling. And they demand more electricity, and therefore they burn more fuel in power plants. And the numbers tell us that in normal summer, they increase consumption by about 1.2 million barrels a day in July and August. So once the summer is over, they have at least 1 million barrels to dump on the market by diverting it from domestic consumption to exports. So between China, between OPEC, between the SPR and the end of the summer, we do have plenty of oil to cover. if we have any shortages. Sadly, and I know a lot of people will be shocked by this, we have people suffering from shortages right now, and they are not in Israel and they are not in Iran. Because as a result of this war, as part of the unintended consequences, now I have shortages in Egypt, Jordan, and Iraq. And the situation could be very severe in a week from now, and here is why. Israel feared that Iran might attack its largest gas field, so it shut it down. And that gas field export natural gas to Egypt and Jordan, and they depend heavily on it. And now we're getting into the summertime where they need that gas badly, and now no more. So what both countries did is utilities in Egypt resorted to burning diesel, but we knew 2 days ago that Egypt has only 7 days of supplies of diesel, which means that they have 5 left. And Jordan basically is resorting to fuel oil. They can literally ship the fuel oil from Iraq via tankers to Jordan. But here's the problem. Iran is no longer supplying Iraq with electricity because Trump did not give them any exemption. And now Iranian gas supplies to Iraq decline substantially. So Iraq is going to need that fuel oil that will send to Jordan. So they're not going to supply Jordan. So we'll have shortages in all those countries as kind of a byproduct of this war.
Yeah.
And if the summer is going to get really hot in those countries, we are going to have a crisis.
Honestly, I think some of the insights you're able to provide are fascinating. It really goes far beyond just what you see in the headlines, social media, and what have you. But I do want to, in the limited time we have left, kind of, wrap this up a little bit, tie this up with a discussion of price. I mean, before any of this happened, I think US WTI was $57-$58 at the low a month and a half ago, give or take. We're recently trading around $75. It sounds like, from what you're suggesting, this isn't going to be some super spike type environment because we have all these mitigating factors, correct?
This idea of $100, $120, $130 basically is based on the assumption that Iran is going to retaliate and destroy capacity in the other countries. If this happened, then they are right.
Okay.
But if none of that happened, what you see today is the maximum. In fact, we have 5% increase today simply because all the rumors that we are going to enter the war tonight and hit the nuclear targets within Iran. The issue is if the US just used those big bombs and they bomb the nuclear sites and that's the end of it, that's fine. The problem is there is really fear that the Iranians might retaliate by hitting US bases in the region. And that's why prices went up.
Yeah.
But if there is nothing by tomorrow, then prices will go back and retreat. And that the 5% that increase we've seen today, we are going to lose all of it. So it is the Trump statements basically that led to this increase. And this is a major change because there is a big difference between Trump giving the green light to Netanyahu and Trump participating with Netanyahu. The implications are completely different.
And I guess one last question I have for you is just if there was anything that would change your forecast, again, sticking in the realm of geopolitics versus weather and all these other things that can happen in the global market, what would it be? Is it other countries entering the war? Is it some kind of thing that we haven't yet talked about that would bring a much higher oil price into the equation?
The question is, of course, we have to distinguish between the government of Iran and the regime, because the government are the official figures of the government, and then the regime like the Revolutionary Guards and others. And it seems that sometimes their interests do not match. And then they have their cronies in Iraq and Yemen and other places. So the question is, as you know, with the advancement of technology, all it takes $700-800 to buy a drone and cause or wreak havoc on something. So it's unlike the past where you need organized people and money. And right now, it's the advancement of technology, you don't need that much. So that's where the surprises are. It's not from the Iranian government. It's from those surrounding it behaving in a way that is unpredictable, and we don't know who they are. And we've seen the attack on Aramco in September 2019 when we lost 5.5 million barrels a day. So it's not necessarily that the government of Iran will do something, it's the cronies doing something that we don't know where they are, we don't know who is going to act, we don't know who they are, we know nothing. All we know is that something will happen. And that will change everything.
Anas, I appreciate this time, you taking time out on a very busy point. The level-headedness, the data you're providing is extremely helpful. We can all just hope that things work out and monitor events as the week goes on, I suppose.
Well, I mean, I'm looking forward to the July event in Las Vegas. And if these events just end in the next few days, then we will have a completely different topic. If they continue until that time, then we'll have updates.
Excellent. Well, listeners, viewers, if you're watching this or listening to it, as Anas alluded to, he's going to be joining us for the Money Show Symposium in July. It's July 15th to 17th. Clearly, there's going to be a lot to talk about, regardless of how things sort out in the next few days. So you're definitely going to want to check that out. Anas, thanks again for your time today.
You're welcome. Have a great day.
My second guest is Joseph Cavatoni, Senior Market Strategist for the Americas at the World Gold Council. He has decades of experience in the capital markets, knows the precious metals world inside and out, and will break down the key drivers any investor in the space needs to understand. Okay, Joseph, I know that there is a ton to unpack here in the precious metals and the gold market, given everything that's going on in the world. So I just want to maybe start at that 30,000 feet up level. More recently, this geopolitical situation, the turmoil we're seeing in the Middle East, you know, as we're recording this, it's a Tuesday. We'll see what happens when we air. But what are your thoughts on the impact of that on gold prices, gold demand in the big picture here?
Well, thanks for having me, and it's great to be on the program. And it's a great place for us to start because I think it speaks a lot to what we focus on with investors. And it's where they're best suited, and most institutional-minded investors in particular are well versed. And that is with risk and uncertainty and understanding gold's role as a safe haven asset. And actually, in moments of market turmoil and inability to assess risk and protect your asset base well, or when things are very volatile, uncertain. And everybody knows that gold's performance in those types of moments, in those types of markets is exceptional. But I think what's actually quite dynamic and interesting about gold, and we can talk a little bit more about what are the driving factors of why.
Sure.
But what we spend a lot of time talking to them about is the fact that you shouldn't be racing to gold. You shouldn't be jumping into gold at a moment of geopolitical risk or market risk that's flourishing and kind of hitting the scene immediately.
Yeah.
We try to convince them that this is a ballast that you can hold in your portfolio. It will protect you on that moment of downside risk. And we have some interesting statistics around the last 12 drawdowns in markets where you could see gold's performance from being flat to down slightly, and the 6 months subsequent to that being up on average around 4 to 6%. So you can see in these drawdown moments that it works well. But we try and make sure they understand, keep the position long, stay invested, because over the time that you need to have it, you'll be able to get price appreciation on the upside as well. So it performs well in good markets.
Yeah, you know, it's interesting you bring that point up. I've had some of the other speakers that are involved in the market, and they say, you know, if you're just buying it for that, you know, you may end up being disappointed in the short term. You've got to look at the bigger picture, right?
You most certainly do. And look, at the basis of all the analysis we do and the work that we spend trying to get our research bed ready for people, is we basically unpack what we call the investment case for gold. And there are definitely tactical factors, momentum, opportunity cost. You've had a lot of those weighing in on the volatility of the gold price, but those tactical factors are 1, 3, 6 months. We talk to them about the strategic drivers for gold: economic expansion, which is wealth creation, growth in economies, and actually the basic idea that people save and spend. And that's where gold actually plays a role. You know, there's a large component of gold that is just still a consumer asset. It's consumer in the form of savings, but also in the form of spending. And ultimately, that's what raises gold up and gives it that average return over 20 years, as an example, of about 8%, rivaling that of equities. So these factors are at play. So you definitely buy yourself the insurance and the protection, but what you're really getting yourself is an asset that can sit tight. You can hold it for the long haul, and it'll perform both in good times, but definitely, as you know, in the downside.
Let's talk about the last couple of years here. I mean, we've seen gold either rise or hold its own in rising dollar phases and
Mhm.
falling dollar phases. We've seen it tend to do okay when interest rates have been rising and doing even better when interest rates have been slumping. It's a very interesting dynamic because sometimes historically people say, "Oh, I only want to own it when the dollar is falling," or "I only want to own it when rates are falling." What are your thoughts on that? What are some of the things that are giving it the fundamental strength despite some of these other things that historically have been impediments?
This is probably the best question to ask because this audience needs to understand the fundamentals of gold. And one thing we always start with when we talk about the gold market is that the gold market is global and that you can sit in the US and understand what's playing out with the dollar assets, rates, monetary policy, etc. But there are forces bigger than that at play and consumption profiles like around the globe that are actually more meaningful, more impactful on what's happening with the gold price. So while we've been sitting tight watching a Fed hold or waiting with bated breath for the rate cuts to inevitably come as our inflation environment in the US starts to show signs of improvement, what you're seeing and feeling are the price effects of not only central banks that have been buying, but global investors uptaking the asset. China's a great example where it's a very major market in its own right. Has a large equity market, a deep and rich bond market, lots of opportunities to invest in a wide variety of different assets, including gold, the physical form, and through exchange environments, and through exchange traded funds and infrastructure products. And it's that type of a market, that type of Eastern investor,
Yeah.
which over the course of the first half of 2024 really drove investment demand and had more impact on the gold price than waiting for the Fed to move and waiting for the dollar to move. So it's actually global in nature. And we want people to broaden out their understanding that yes, the dollar as a reserve asset, dollar assets as reserve assets, they're all important. They are factors that need to be considered as part of a global analysis of what's going on in the gold market.
Got it. And I'm glad you brought up the global and the central bank part of this equation here. That seems to be, again, without having the numbers in front of me, we've seen pretty steady, pretty persistent buying in multiple countries, right? And I'm curious if you could maybe expand on what's driving that. Why are central
Sure,
banks more aggressively, I guess is the term, moving into gold than maybe
sure.
they had in previous years?
So let's put some size and scope to it because I think it's really important for people to have some clarity that this is a trend that's actually been pretty aggressive and actually showing signs of continuing to go in this direction for the foreseeable future. So this is a 15-year trend that global central banks are actually net buyers of gold. So we track the purchases and the sales, and we look for the net result. 15 years of net buying by the central banks on a global scale. Many of them are emerging market or developing market central banks. And in the last 3 years and into this fourth year, what we've seen is nearly 25 to 30% of annual consumption of new gold is going to the central bank community as a reserve asset. Now, that's record setting in 2022, near record setting in 23 and 24. And actually, as of first quarter, we're a little behind pace for record setting again,
Yeah.
but we're still looking at a 250 ton market that was consumed in first quarter. And each one of those years I referred to, you're seeing at least 1,000 tons of gold being purchased by these central banks. Now, we release an annual survey with these central banks that we go deep into the questioning around what's happening with their reserve portfolios and how gold fits into it. Nearly 95% of them, as a community, said, we think our community is going to continue to add gold to our portfolio. In addition, about half of them said they're going to be increasing their overall allocations to gold. And most of them are making the decision on the basis of what we talked about a moment ago.
Yeah.
What am I looking at in my portfolio, and how's the US dollar or dollar based assets, which have been that natural safe haven diversifier in particular for smaller emerging market central banks, That's what they hold as their reserve asset of choice. They're slowing down their uptake and maybe even lowering their exposure to it over the next 5 years. That's been something they've been signaling to us for 3 years now. And what's at the heart of it? Inflation,
Yeah.
challenges around managing the overall costs and risks in their portfolio. They need an asset that they can trust. They need liquidity, and they need to make sure that they can access it unencumbered in any way. And that global nature of gold gives them that right. Even have the opportunity to bring it back to their home country or leave it in places like the Bank of England in the middle of the wholesale market where
Sure.
they can actually use the value of the gold and actually extract even more value out of it by having it in a lending market or supporting the trading markets in London. So, really, an interesting dynamic playing out there. And again, the signaling that we continue to get from central banks. Will we set a record of this year or not? I'm not sure. But again, it's looking very favorable as one of the four key use cases we see: reserve assets and gold holdings.
Got it. I want to talk about supply in a minute, but before we kind of get off the demand side of the equation, I mean, let's talk about ETF flows, the investor money
Yeah.
versus what central banks might be doing. Obviously, we've had a huge rollout in Bitcoin ETFs that allow people to theoretically
Hmm.
say, I can buy real gold or I can buy digital gold, whatever term you want to use. How has that impacted the market? How do you think that sort of debate or discussion is going to unfold in the next year?
So there's a couple of things that I think we should probably start off with. And I think that it's fair to say we believe gold investment and investors that have access to gold have been underallocated based on a few factors that are key. Number one, the level of risk and risk assets, where they're trading. Number two, the speed with which they can show a moment of drawdown and risk can have significant impact on their valuation. And number three, the ability for a bond portfolio to provide what you need it to, which is diversification. Risk is tracking between bonds and equities, and correlations are higher than they've ever been. So you're not really getting true diversification with that. We believe they've been underinvested, and we actually think that they're actually now realizing that the world that we've just seen unpacked by the new administration is realizing these risks in a way that's probably unprecedented. And I think what we're starting to see now is we've seen ETF flows not only in the Americas, but in Asia, which was actually record setting last year in Asia. But Americas are back to the table and they're looking quite aggressively about what's the right mix and what's the right kind of allocation I should be holding in my portfolio. But within that investment community, they are a little bit comfortable staying in risk right now, and they aren't moving that quick to make the allocations. But we're keeping a keen eye on it because we continue to think that that will be an area for growth. Now, as it relates to Bitcoin, it's really an interesting discussion. For us, many people have tried, and I guess it's been somewhere in the range of 10 years now,
Hmm.
to tell the market that Bitcoin's the new digital version of gold. And it's based on a few simple facts. They mine Bitcoin, there's a limited amount of supply. But quite honestly, the dynamic of what that market is and how it behaves and who's involved, and really a challenge of understanding what the use cases are, make it nothing close to what it is when it comes to the world of gold. If you think about what they're saying about mining and what we see when it comes to mining gold, radically different businesses. But more importantly, when you take that asset and you look at it, Bitcoin that is, and you start to unpack it, what you're going to find is it's a risk asset. It correlates with tech stocks. Many people who are investing in it, who have invested in it, have actually understood that they're trying to get the exposure to a new world of technology, a new way of thinking about using the tech to actually, expend their monies and actually get their investment exposure. But it isn't really doing what gold does. It's not an inflation hedge. It hasn't shown us that it performs in drawdown moments because it tracks with risk. So we think it's an interesting part of the market, but the conversation we have is when you're looking at Bitcoin and adding it to your risk portfolio, let's talk about what the impact is of adding more gold as an allocation to offset that risk. And that's really what it's been. The ETFs are actually kind of a cool thing. We benefited when ETFs were brought to the market for gold.
Sure.
They're benefiting. It's giving people certainty. RIAs are able to move into the market much more aggressively now and have some certainty around what they're dealing with. It's got a form of regulation. But at the end of the day, you're still looking through the asset and you're looking at what it does when it needs to perform the way that you want it to. And that's where it's a basic risk asset.
Okay. On the supply side, anything, sort of some intelligence you can share there. I know it's interesting. Some of our speakers earlier in this kind of move for gold, it was, oh, why aren't the miners doing anything? The metal seems to be doing better. The miners weren't. And a lot of the talk was it's expensive to produce, the inflation in labor, raw materials costs, energy, you name it. Are miners still facing those obstacles, and or do you think the environment on the supply side, how that's going to unfold?
Well, I think the mining space is actually a very interesting place for people to look. But I think it is important, and I think as you highlighted, it's not a pure exposure to the metal itself. So you have the opportunity to express a view with an equity and a company, which might be what you're interested in, or the metal itself. If you're looking for the attributes of the metal itself, there's plenty of ways to get that done, whether it's in physical form or financial instrument. But what's actually interesting about the mining stocks, what's interesting about why they still remain in our minds, something people should definitely take a look at, is that they do benefit from the higher prices. And they are looking in an environment today which might be favorable for mining, favorable for permitting, opening the door for critical minerals and beyond that to actually become more of a part of the economy in the US, for example. A lot of the discussion between the US and China is based on everything we're talking about with miners. They're at the heart of all of that. You're right. Production, time to market, speed with which you can get it done, the costs that have come with an inflationary environment of energy cost, fuel costs, employee costs, getting employees to these sites, and getting permitted, they all are challenging environments that the miners have to continue to navigate. But within the mining community, you've got streamers, you've got miners, you've got fabricators, you've got producers, you've got milling companies. There's a lot to look at. I still think it's a very exciting and interesting place. But you need to understand that when you're looking at the mining community, you're looking at a company with a management and an operating platform that needs to actually perform in a market. One last point on the mining companies that I
Sure.
think is actually pretty fun is actually the use of technology at the mine sites. I've had the opportunity to see a number of mines from our member firms. Some of them are using autonomous vehicles. Many of them are using modernized technologies to generate power that gets put back into the community. So from an environmental perspective, that might not necessarily be a friendly environment in the new administration, but it's an important thing to understand. They're actually taking what they can do in the world of modernizing technologies, and they're actually using it as part of a broader community and paying back to these communities around the globe where they actually have, pretty large operations, whether it's in South Africa or it's Australia or Canada. And it's actually it's encouraging to watch them use modern technologies and use this type of activity to kind of really bring mining and gold to the market in a responsible way that we appreciate.
Got it. I guess one last thing before I get towards the close here would be gold versus some of the other metals out there in the precious space. It's interesting. Gold moved first. You're starting to see silver move. Platinum even's garnering some attention. What does an investor need to know about the relative merit of gold versus some of those other metals they can invest in?
Yeah, this is a good question and actually something we spend a lot of time unpacking for people as well. It starts with understanding use cases for a precious metal. And when you look at the use cases for gold, you've got investment, central banks, jewelry and consumables, and technology. The primary activity that's taking place in the gold market is linked to the economy, the outlook for the economy, monetary policy, savings, and wealth. Silver, platinum, palladium have more and more technological or industrial uses. About 70 to 80% of silver, for example, comes in the use case comes in the form of industrial use. And I think that it's actually a different driver. So you might see economic impact on silver, but it'll take longer to show up in the silver price because it is around how does that economic impact the industry where it's fueling the growth or being curtailed by the growth. So ultimately, it takes longer for it to show up. We're at the tip of the spear when it comes to people's sentiment around economic future. And actually, the gold silver ratio is something that people often talk about. In the last couple of weeks, people have been talking about how it's at over 100. And you basically say, let's not think about it as silver underperforming. This is about what the market and what the investor is telling us about their economic outlook and their concerns around these policies, and gold's moving away from silver. So that higher number is actually telling us something very interesting about investment sentiment. Now you're starting to see it balance out a little bit more. Why? Because we can see a road where silver's role and the economies might be beneficial for silver. So you're starting to see it catch up now. So that's what
Got
we
it.
should tell
Perfect.
people. Just look at use cases and understand what's driving prices.
Understood. Well, Joseph, I guess my last question would be, we're pleased to have you joining us at the Money Show Masters Symposium that's going to be in Las Vegas in July next month. Can you just briefly summarize, somebody comes to your presentation, what are they going to learn about? And, why isn't, what are some key takeaways, I guess, that they can look forward to?
Yeah, I think we'll be able to recap a lot of what's been going on in the world in terms of the use cases that we have. But two things that I think that we should let them make sure they understand are going to be part of what I talk to. The first is better use of technology and continual evolution of the market. Right now, we've been working with industry participants like the Bullion Banks, the London Bullion Market Association, and working on the Gold Bar Integrity Program using blockchain technology to track and trace gold. There's work underway to digitize gold and let it be used more comprehensively in the wholesale community. We've patented a standard gold unit, which will be at the heart of a lot of that work. We're excited about a pilot program we ran last year using gold as collateral. So if you can think about a world where it starts moving much more efficiently amongst banks and that trading market for collateral purposes, and then ultimately coming to market in a way that maybe you can even buy it easier and quicker in the digitized sense. So that's one thing. And then secondly, we think we'll be able to share more about some of the work we're doing in a space on the supply side, the artisanal small scale gold mining side of the market. That's where we're actually seeing this growth in the gold market, higher prices, bringing something that's actually really a concern for us, and that is maybe not necessarily the right element to artisanal mining, where a community might be making a meager living off doing artisanal mining. The bad elements are sneaking into it. And we want to stop that. We're working with governments around the globe to find the right way to not only use enforcement, but also incentives, economic incentives, and connecting the right people within the communities locally to really bringing together a market that actually says we can trust, track, and trace artisanal mining, leave the economies at home to benefit from some of that gold being brought out of the ground, do it in a responsible way, and curtail any of these bad elements that are getting in the fringes of our market.
Got it. Well, listen, Joseph, I really appreciate taking some time out to chat. I know it's a busy market environment. A lot of things are driving gold here. A lot of people are curious about what's going to happen in this space. So if you're watching this, viewers, again, as a reminder, Joseph will be joining us at the Money Show Masters Symposium. It's July 15th to 17th at Caesars Palace. Again, coming up in next month. We hope to see you there. Joseph, thanks so much for your time.
Thanks for having me.